Okay, let's unpack this. We're diving into, well, a bit of a financial puzzle today. It's wrapped up in the 2016 Shareholders Letter from a major holding company.
Yeah, it's genuinely jarring when you first look at it because if you just glance at the bottom line for 2016, you see this huge net loss. We're talking what, over $500 million?
$512 million, yeah. And a 6.4% drop in the company's book value per share. I mean, on the surface, that looks like a really rough year.
A disaster, you might think. But then you read the letter itself, and right at the start, they call 2016 the best of times for their core operations.
Exactly. And that's the paradox, isn't it? That's what we need to figure out for you. How can a company lose that much money, yet honestly claim it was one of their best years operationally?
Well, the short version is that the underlying business, especially the insurance side, was performing exceptionally well. But that success got completely overshadowed by one very specific, very sudden, and very expensive strategic decision they made late in the year.
So our mission here is to untangle that. Understand the tension between, that short-term market hit and the long-term value they were building.
Right. And maybe start with the good news, the operational side.
Yeah, let's do that.
Yeah.
Because the insurance engine was absolutely humming. They reported a consolidated underwriting profit of $576 million, which, as they point out, was their second best underwriting result in like 31 years. Only 2015 was better.
And the key metric there, as you know, is the combined ratio. Just to remind everyone listening, that's basically expenses plus claims paid out divided by the premiums they took in. Anything under 100% means they're making money just from the insurance itself before any investment income.
And their overall number was 92.5%. That's really strong. It means for every dollar in premiums, they kept almost 8 cents as pure underwriting profit.
Solidly profitable. And it really speaks to their whole model, doesn't it? That decentralized kind of entrepreneurial culture they always talk about.
Absolutely. And you
Mhm.
see it in the specific examples they give. Like Cenus, their workers' comp insurer, they posted an incredible combined ratio of 79.7%.
Yeah.
That's like making 20 cents profit on every dollar of premium.
Yeah, nearly 20 cents. And they frame that as a reward for patience, right? They mentioned supporting Zenith earlier when its expense ratio was high, and now it's paying off in spades, as they put it.
That's definitely their long-term view playing out, supporting management, letting them run things. Odyssey, their reinsurance group, also had a fantastic year. What was their number?
88.7% combined ratio, which was the fifth year in a row they were below 90%, just exceptional consistency.
So when all your main insurance businesses are running that well, below 100%, that core engine is just throwing off cash profitably.
Exactly. Which provides a really strong foundation. But like you said, it just makes that huge accounting loss even more stark. How did that happen?
Okay, here's where it gets really interesting, as the letter puts it. The trigger for the massive loss, the thing that flipped the script, was entirely down to one single day, November 8th, 2016.
The U.S. presidential election.
Yeah,
That one event caused them to completely reverse a defensive investment strategy they'd held for years. And that reversal led directly to that net investment loss of around $1.2 billion for the year.
wow. A $1.2 billion swing. That's
Yeah.
enormous. So what did they actually do in their investment portfolio? And why did unwinding that strategy cost so much right then?
Well, it was incredibly swift. They basically decided almost overnight that the economic outlook had fundamentally changed because of the election result. So they removed pretty much all their equity index hedges, got rid of some individual short positions too, and crucially, they slashed the duration on their bond portfolio, cut it right down to about 1 year.
Okay, reducing the bond duration. Explain that a bit. Why sell off longer-term bonds, and why did that trigger such a big recognized loss?
You have to understand the context. Since about 2010, they'd been running this very defensive strategy. They were worried about, global economic problems, deflation, all sorts of risks. So they had these hedges in place. Think of it like an insurance policy against a market crash. And like any insurance, it cost money.
Premiums, essentially.
Exactly. Over those 7 years, the net cost of that protection, the hedging losses, added up to something like $4.4 billion. Now, they did make money on their stocks and bonds during that time, which offset some of it, making the overall investment result closer to break even over the whole period. But the protection itself was, as they say, very costly.
Okay, so they paid billions for protection over 7 years.
Right. Then November 8 happens. They decide the big risks they were guarding against are suddenly less likely, and maybe even the opposite risk, inflation from growth, is now the bigger concern. So they cancel the insurance policy, they unwind the hedges, and when they do that, they have to book the cumulative cost of that now abandoned protection. That's where the $1.2 billion hit comes from. It's the realized cost of dismantling that 7-year defensive wall.
Got it. So it wasn't necessarily a bad investment made in November, but the accounting recognition of the cost of the protection they no longer felt they needed. And the reason for flipping so fast was,
Yeah.
what? What did they expect the new administration to do?
Their stated rationale, and we're just reporting what's in the letter here, was an expectation of, well, pretty radical policy changes. They anticipated dramatic cuts to corporate taxes, talking about going from 35% down to maybe 15 or 20%, plus rolling back regulations and a big push on infrastructure spending.
Right.
And their bet was that these policies, if enacted, would unleash, quote, animal spirits in the economy, drive much higher economic growth than people were expecting.
Which leads back to the bonds.
Exactly. Because if you get higher growth, you probably get higher inflation, and that usually means interest rates go up, especially longer-term rates. If rates go up, the value of existing long-term bonds goes down. So holding lots of long-duration bonds suddenly looked risky. That's why they pivoted so quickly to short-duration stuff. They paid the price for their past caution to get ready for what they saw as a new, more aggressive economic phase.
Makes sense. Pay the cost to reposition.
Yeah.
But interestingly, they didn't get rid of all protection, did they?
No, that's a good point. They kept significant deflation swaps, about a $110 billion notional amount, with 5.5 years left, and they held on to about $10 billion in cash. So they weren't completely throwing caution to the wind. They still cited risks like protectionism, potential trouble in China, or the Eurozone falling apart. Vigilance remained, just less hedging overall.
Okay, so a massive investment pivot based on anticipating future policy. But while that was happening, they were also incredibly active on the expansion front, right? This loss didn't seem to slow down their M&A.
Not one bit. It was actually a huge year for expansion and acquisitions. The biggest news came right at the end of the year, in December. They announced an agreement to buy Allied World, $4.9 billion deal. They called it potentially their largest and perhaps most significant acquisition in history.
And Allied World fits their typical profile, doesn't it? Strong performer.
Absolutely. They highlighted Allied World's track record, an average combined ratio of just 90.7% since it was founded in 2001, and significant reserve redundancy, meaning they'd consistently set aside more than enough for future claims, just a high-quality insurance operation.
And crucially, they emphasized how they plan to integrate it, or rather, not integrate it too much.
Right. They specifically said the plan was for Scott Carmilani, Allied World CEO, to keep running it in their usual decentralized way. And they made a point of saying they weren't banking on huge cost savings or synergies. Their phrase was no execution risk and no disruption. That's classic Fairfax philosophy. Buy good companies with good managers and let them do their thing. Don't try to smash things together just to cut costs.
They're buying the talent and the profitable float, essentially.
That's the model. And they weren't just buying in North America. They were expanding everywhere. In Africa, they bought Zurich's business in South Africa, rebranded it as Bright Insurance. Big move there.
And Europe and Latin America, too, picking up pieces from AIG.
Yeah, that was another major theme. They acquired AIG's property and casualty operations in 6 Latin American countries, plus some assets in Central and Eastern Europe, places like Bulgaria, Czech Republic, Hungary. And what's really interesting there is the management piece again. They often hired experienced managers from AIG to run these newly acquired businesses. People like Fabricio Campos in LATAM, Peter Sikvaris in CEE. It's like they were capitalizing on instability at a competitor to grab not just assets, but proven talent.
Resourceful. And Asia wasn't left out either, right? Indonesia.
Correct. They bought an 80% stake in an Indonesian insurer called AMAG. Again, strong track record, average combined ratio under 90% for the last 10 years. That strengthened their presence in Indonesia, building on an existing bancassurance deal they had with Panin Bank. So really a global push.
Okay, so while the investment portfolio saw this huge one-time hit from the strategic shift, the underlying insurance operations were strong, and the company was aggressively expanding its global footprint through acquisitions. Let's pivot now to the other side of their business, building value outside of insurance. This is where things often get less volatile day to day, but the long-term compounding can be huge, that hidden value idea.
Yeah, and you see that super clearly with their investments in India, specifically through their subsidiary Thomas Cook India and its own major holding, Quest Corp. The Quest story is just phenomenal.
Give us the rundown on Quest. The numbers are pretty staggering. Keep it simple, though.
Okay, so back in 2013, they bought a 77% stake in Quest, it was called IKEA back then, for just $47 million. That valued the whole company at around $60 million. Fast forward just 3 years to 2016, Quest goes public, listing 10% of its shares. That IPO valued the entire company at $600 million.
Wow. Okay. From $60 million to $600 million valuation in 3 years.
And it gets better. Soon after the IPO, the market traded the stock even higher, pushing the total market value of Quest up to over $1.2 billion.
That's like a 20 times increase on the initial valuation in just 3 years. Incredible.
It really is. And the key point for the shareholder letter is that because Quest is consolidated within Thomas Cook India, these massive gains in market value weren't showing up directly in Fairfax's reported earnings line by line, but the underlying value creation was enormous. They calculate that Thomas Cook India's book value per share jumped something like 847% over 4 years once you mark the Quest investment to its market value.
So that's serious hidden value being built, even while the main company reported that big net loss due to the investment hedges. It shows the power of these non-insurance holdings.
Exactly. And it wasn't just India tech and services. They were also busy building their Canadian restaurant empire, Cara operations.
Right, the restaurants. How does owning chains like Swiss Chalet or Harvey's fit into an insurance holding company strategy?
Well, it's diversification, primarily. Owning high-quality, cash-generating assets that aren't correlated with the insurance cycle. And they were growing Cura aggressively. In 2016, they made 2 big acquisitions there. They bought St. Hubert in Quebec, which is famous not just for its chicken restaurants, but also its food manufacturing business, huge brand in Quebec. And they also bought the original Joe's Group, adding about 100 restaurants, primarily in Western Canada. By the end of 2016, Cara had over 1,200 restaurants, making it the 3rd largest chain in Canada.
So buying established cash-flowing businesses, anything else significant on the non-insurance side?
Yeah, they mentioned the Keg Steakhouse chain had its best year ever. They launched Fairfax India as a separate investment vehicle, raising over $1 billion and deploying it into 8 Indian companies. And they recently listed Fairfax Africa as well, so consistent building of these different pillars of value.
Okay, let's tie this all together then. We've seen record insurance results, a massive but strategic investment loss due to a macro pivot, aggressive global acquisitions, and steady value creation in non-insurance assets. If we zoom out, despite the $512 million loss in 2016, how does the long-term picture look? Because that's always their main focus.
Immense. They make sure to remind everyone of the 31-year track record. Even including the 2016 loss, their book value per share had still compounded at 19.4% per year since 1985. Include dividends, and it's over 20% per year. That kind of long-term compounding smooths out the bumps of any single year.
And the engine that allows them that long-term perspective, that patience, is the concept of float from the insurance businesses, right? We touched on it, but let's define it clearly.
Right. Float is basically the insurance premiums they've collected but haven't yet paid out in claims, plus reserves they hold. It's money they hold temporarily, but they get to invest it for their own profit while they hold it. Ideally, you want to generate float at an underwriting profit, meaning you actually get paid to hold this money. It's like getting a negative interest rate loan.
And how do they do on that front? What was the cost of their float?
This is incredible. Over the last 10 years leading up to 2016, the cost of their float wasn't a cost at all. It actually provided a benefit of 1.1% per year.
They were effectively getting paid 1.1% annually to hold billions of dollars of investable cash.
Exactly. Compare that to, say, the Government of Canada's cost of borrowing over 10 years, which they note was 3.1%. Having float that pays you while the government pays to borrow, that's a massive, durable, competitive advantage.
It allows them to ride out bad investment years, be patient with turnarounds like Zenith, and make those long-term bets.
Absolutely. And they use examples like Odyssey Ray, again 20 years under their ownership, $876 million in cumulative underwriting profit, $4.6 billion in net earnings. Or Northbridge in Canada. Started as an almost bankrupt trucking insurance company back in '85, grew into the 3rd largest commercial insurer in Canada, compounding book value at 19% a year. That's the power of combining disciplined underwriting with patient investing, fueled by low-cost float.
Okay, so what does this all mean for someone trying to understand 2016?
Well, I think the letter perfectly captures the inherent tension in their strategy. You had this huge, visible negative number, that $500 million loss. But it wasn't because the business was broken. It was the realized cost of making a massive bet, abandoning a 7-year defensive posture to reposition for what they saw as a fundamental shift in the U.S. and global economy.
Paying the price to switch from defense to offense almost literally overnight.
Right. And at the same time, the underlying engines, insurance underwriting, global acquisitions, building value in places like India and Canada were firing on all cylinders, creating intrinsic value that wasn't necessarily reflected in that single year's bottom line.
That really sets up the final point, doesn't it? The letter itself warns about potential bubbles.
It does. They explicitly call out the Canadian housing market as looking like a bubble.
Hmm.
And they take a swipe at the tech sector's valuation, using Snap's IPO as an example, $33 billion market cap on, $400 million in sales and a $500 million loss. Classic value investor skepticism there.
So here's the final thought for you, the listener, to mull over. They made that huge, costly pivot away from their defensive bond strategy because they anticipated a major economic shift, right? They basically sold bonds that had generated significant capital gains during the post-crisis era. Does their discipline in exiting that position and their current state of caution about avoiding hot markets like high-tech and Canadian housing, does that signal that they might be positioning themselves again for the next big inflection point? Is their avoidance of today's bubbles the same kind of forward-looking move as their bond sale was back then? Something to think about.